Assalamu alaikum. Hello everyone. Can you people hear me? So great. So we discussed how to calculate net present value using spreadsheet. A quick recap what we did in the last session. We discussed how to calculate tax benefits on capital allowance and balancing allowances. We also discussed how to calculate working capital, how to incorporate inflation into our investment appraisal questions. Now, we'll be solving another question in which we have to calculate net present value, but there's some addition to the net present value calculations, which is the inclusion of probabilities. So how we incorporate probabilities into our net present value calculation, this is what we are about to start. On your screens, I hope you can see the question right there on your screens. Well, Abdullah, I'm working on it, and I'll be requiring few details from all of you. So just give me a day, um, and you people will get the access. But I have shared on the WhatsApp group. I've shared the number, the questions that we'll be solving today, the details of the questions that we'll be solving today. So let's start from the question. Rexon Company is appraising an investment project which has an expected life of 4 years and which will not be repeated. The initial investment payable at the start of the first year of operation is $5 million, with a scrap value of $500,000 is expected to arise at the end of 4 years. There is some uncertainty about what price can be charged for the units produced by the investment project, as this is expected to depend on the future state of the economy. The following forecasts of selling prices and their probabilities have been prepared. Future economic state: weak, medium, strong. The probability of having a weak economic state is 35%, with the medium being 50% and strong being 15%. Selling prices will be $25 if the economic state turns out to be weak, 30 for medium, and 35 for a strong economic state. These prices are expected these prices are subject to annual inflation of 4% per year, regardless of which economic state prevails in the future. Forecast sales and production volumes and the total nominal variable costs have already been forecast as follows. Incremental overheads of $400,000 per year in current price terms will arise as a result of undertaking the investment project. A large proportion of these overheads relate to energy costs, which are expected to increase sharply in the future because of energy supply shortages. So overhead inflation of 10% per year is expected. The initial investment will attract tax allowable depreciation on a straight line basis over the 4-year project life. The rate of corporation tax is 30%, and the tax liabilities are paid in the year in which they arise. Rexon Company has traditionally used a nominal after-tax discount rate of 12% per year for investment appraisal, and what we are supposed to calculate is the expected net present value. Now, we have to calculate the expected net present value. The only thing that we're not sure of is the selling price. So we expect price to be 35. We expect the price to be 25, 30, or $35. depending upon the future economic state, which we don't know. So before we move uh, towards solving the question, calculating the NPV, let's first do a small working. And this working will be for calculating expected selling price per unit. Since we don't know what price will be for this project, therefore we need to calculate the expected price using the expected value approach. So what we have to do is to just pick up all the expected prices and multiply them with their respective probabilities, and then sum them all to find out the average selling price or the expected selling price. So 25 is what we expect when there will be a weak economic state, and the weak economic state will have the probability of 35%. So we have to multiply 25 the price with its probability 35%. And then we'll be picking up the next price, which is 30, and multiply it with the probability, which is 50%. Then it's 35 with the probability of 15%. Now, if we enter it, we'll get the weighted average price, which can also be called as expected price. So it's $29 per unit. So instead of using either of these three prices or all of these three prices and come up with three different expected, net present values, we have to calculate a single net present value, which we can call as expected net present value. The expected net present value means the average net present value that we expect in the future. So we have to average out all variables in which we expect variations. Luckily, in this question, we don't have to do this average calculation for more variables. We just need to do this calculation for only one variable, that is selling price, because we do not expect variations in any other variable. So the expected price will be 29. Now, for every year, we'll be using this price as our price, and then we'll be inflating this price accordingly. So let's now start calculating net present value using the pro forma. I'm just cutting this working and taking it down, because we are not supposed to show working right at the top. So we'll make sure that we show working at the end of our main calculation. So let's prepare the NPV pro forma. I think we should write these figures in thousands, as we always do. So we'll start from 0, 1, 2, 3, and 4, since it's a 4 years project. So let's start from the sales. Sales volume for the first year is expected to be 150,000 into the price and into the inflation rate, which is 4%. So 1.04. So 4524. Let's change the format. So for the second year, the sales volume will be 250 into the price into 1.04 raised to the power 2. 4. Then we have a sales volume of 400 into 29 into cap raised to the power 3. 400 into this power 3. 04 power 3. 13048. And for the last year, the sales volume will be 300 into 29 into 1.04 raised to the power 4. So here we go. We've got the inflated sales figures. Then let's deduct the variable costs. Variable costs. Okay, the variable costs are already provided in total. These are the total variable costs for every year, but without inflation, including inflation, because you can clearly see they have written as nominal variable cost. And whenever it says it's nominal cash flow, it means the cash flow has already been inflated. So we don't need to adjust inflation anymore. We just need to write these figures as they are. 7080 minus 5730. So make sure you are able to identify these small things in the question so that you don't make mistakes. Nominal means inflated cash flows, so no need to adjust. Then we have to adjust fixed costs, and the incremental overheads are $400,000 per year in current price terms, and they are expected to increase at the rate of 10% per annum. So 400 into 1.1, 440. We'll refer back to this, and we'll just multiply it with 1.1. And if you copy it to the next cell, it will automatically inflate these cash flows. Let's put the minus sign, as these are negative cash flows. So all the cash flows got adjusted. So do we have any other cash flows which we need to show before tax? I don't think so. We don't have any other cash flow that we need to show before tax. So let's net off these cash flows to find our pre-tax cash flows. Okay, so these are the pre-tax cash flows. Now let's show the tax liability, which will be at the rate of 30%. And since it was mentioned that we will be paying tax in the same year, so we'll show it in the same column, 30%, and copy, paste all those figures. We'll get tax liabilities for every year. Then it's time to adjust tax benefit on capital allowance or balancing allowance. Okay, now tax benefit and capital allowance will be on a straight line basis. So it means that we will be receiving tax benefit equally every year. So for that, we first need to calculate tax depreciation for the year, and then we'll take 30% of that tax depreciation and we'll include it as our tax benefit. And whatever we'll do for the first year, we'll just simply copy paste it for the rest of the years as on a straight line basis. The benefit will be the same for every year. So let's calculate the capital allowance for every year. The cost of the asset was 5 million, which means 5,000 as right in thousands. And we'll deduct the scrap value from this 500 and we'll divide it by 4 to get the capital allowance figure. Now this is the capital allowance figure for every year. But since it's just the capital allowance figure and not the tax benefit, so we'll just take 30% of this figure to calculate the tax benefit. So 30% of this figure in the bracket. So here we go. Here is the tax benefit for year one. Since it's a straight line method, so we'll be receiving the same tax benefit for all 4 years. Is it clear? Is it clear? Only 2 people saying yes. Great. That's the spirit. Great. Okay, so tax benefit, here we go. We've got tax benefits, and then we will be incorporating scrap value, which is 500 in the last year, and then initial investment, which is 5,000,000, 5,000. Okay. Well, Abdullah, I don't know exactly what that question had in it, but this is actually the same type of question that you're talking about, because we were told that there will be variation in the price every year. Now, definitely, when there is a variation in the price, there will be a variation in the cash flows. So instead of calculating different cash flows at different prices, we just took the average of these prices so that we can avoid showing those fluctuations in the cash flow. So we have already taken the average price, so we don't need to show different possible cash flows for every year. And this is what we are supposed to do in every exam question. Wherever we will see variations in different variables, first we need to calculate the average of every variable, and then we'll use those average figures to calculate average cash flows. So for every variable, we first need to calculate the average. For example, in the same question, like this question is, if we were given uh, variations in the variable cost. So first we were supposed to calculate the average variable cost in the same way as we calculated the average selling price. And then once we have calculated the average variable cost, we'll use the same variable average cost for every year. So these were the cash flows. I don't think we are left with any other cash flow. There is no working capital given in the question. So let's calculate the net cash flows. And the net cash flows will be the sum of pre-tax cash flows from pre-tax cash flows to initial investment. These are the net cash flows. Now let's take discount factor. And I told you that whenever we inflate the cash flows, we'll always take nominal cost of capital. And luckily, we have nominal cost of capital. So it's 11%. So let's calculate discount factors. 1.11 raised to the power minus 0. Okay, so and let's change the format to at least 2 decimal places. And PV, present values. $5,000. There we go. Kindly go back to one of the formula of sale. GS, just wait a minute. I'll go back to that. So net cash flows. These are the net cash flows for every year. We got the discount factors at 11%. And here we go. We've got present values. So let me underline for presentation's sake. So we don't have enough formatting tools, so we have to do this. to make look at least presentable. So here we go, we've got present values, and then let's calculate the expected net present value. Better to write the word expected net present value as asked by the examiner. Sum all the cash flows, and we've got the net present value, but these were in thousands, so let's multiply it with 1000 to get the full value. Here we go, and let's change the format to dollars. So there we go. This is the expected net present value. So which formula were you talking about? Kind of go back to one of the formula of the sale. Okay, here we go. What about the comment about the NPV? Well, in case of commenting in this type of question, it won't be a big paragraph or something, right? You just need to state whether the company should accept this project or not. Since in this question, the expected net present value is positive, so the only comment that will give will be that since the project has a positive net present value, therefore the company should accept this project. That's it. So it will be a one-line comment stating whether the company should accept this project or not. Okay, this is it. For the expected selling price, we have just multiplied the different expected prices with their respective probabilities, and then we have added all of them together to find the average selling price. Yes, you can have those recorded videos on Vimeo, and in the chat box you've got the link to that Vimeo account of ACCA. So you can always view those videos on next day. Show how we calculate the tax benefit. So I hope the question is clear now. Okay, so let's move towards our next question. Well, the next question is about calculating the cost of equity. Well, let me give you a brief explanation of what cost of equity is and cost of debt is and weighted average cost of capital is and how we calculate it before we can actually move towards solving this question. So far we've solved investment appraisal questions in which we were supposed to calculate net present value, and we used to use cost of capital for calculating the present values, and whenever we used to get a positive NPV, we were accepting the project, and whenever we were getting negative NPV, our comment was to reject the project. And the reason was that when you get a positive NPV, it means that you're earning more than your cost of capital, and the cost of capital is actually the return that the company is supposed to pay back to its investors. Uh, and usually the company will have two types of investors. One will be uh, the ones who will be buying the shares of the company and investing through equity, and the others will be the ones buying through will be the ones investing through buying the debentures of the company or giving loan to the company. So we call it debts. So so the company is supposed to pay back the return to its investors, either those who have invested in the company through equity or the others who have invested through debts. So the company is supposed to pay both types of investors their required returns. And when the company will be paying to its equity holders or to those who are holding the shares of the company, that return is called cost of equity for the company. And when the company will be paying back to its creditors who have given loans to the to company or debts to the company, they will when they will be paid their return, it will be called as cost of debt. And the average of the cost of equity and the cost of debt will be called weighted average cost of capital. So before a company starts appraising a project using a discount rate, first it needs to calculate the weighted average cost of capital. Once the weighted average cost of capital is there, then we calculate the present values using that cost of capital, which we have already done. Now we have to calculate that cost of capital which we were using for calculating net present values. So one of the components of cost of capital is the cost of equity. So first, let's learn how to calculate cost of equity. For calculating the cost of equity, we have two models. Cost of equity can be calculated using two main models. One is the dividend valuation model slash dividend growth model, in case growth is given in the question. And the other is the CAPM model, capital asset pricing model. Capital asset pricing model. So there are two models which we can use to calculate the cost of equity. Well, these webinars, let me answer the question. Is this webinar, is the webinar session only suitable for students in Pakistan, or it's also suitable to UK students? It's equally suitable to students in UK, in Pakistan, and anywhere in the world. So there is two basic models for calculating the cost of equity, and the question given here uh, asks us to calculate the cost of equity using dividend growth model. So let's calculate the cost of equity denoted by KE, cost of equity, using the dividend growth model. The dividend growth model uh, let me first write the formula for you in case you don't know the formula of dividend growth model. KE using dividend growth model is equal to D naught into 1 plus G divided by KE, P plus G, whereas D naught is current dividend, the dividend that has just been paid. G is the growth rate. Sometimes it will begin in the question, or sometimes we will be calculating the growth, and we'll learn how to calculate it. And P is the X div price. X div price. So just note down the formula so that I can switch to the spreadsheet window. Should I switch to the spreadsheet window? X dividend as in the previous years. No, X dividend, uh, X div price means the price prevailing in the market just after the dividends have been paid. This is called X div price because when dividends are declared or expected to be paid, the share price of every company goes up in anticipation that anybody buying those shares will get the dividends. So the price goes up, and when that price goes up because of the dividends, it is called cum div price. But the moment the dividend is paid, the price, theoretically speaking, the price will come back to its original position, and that price is called X div price. So we should always use the X div price rather than the cum div price. Is that clear? Okay. So so let's calculate the X div. Let's calculate the cost of equity using the dividend growth model. So we just need to look at the information given. What we need is we need growth, we need price, and we need the current dividend. So we need these three variables, and let's find out whether we have these variables in the question or not. Uh, First of all, uh, let's see if we have the dividend for the current year. A dividend of 62 cents per share for 2013 has just been paid. So we've got the dividend, the current dividend, which is 62 cents. So it's totally up to us whether we write the dividend to cents in cents or we write it in dollars. So let me write it in cents at the moment. So dividend 62 cents. Okay, then do we have any price? Yeah, we have X dividend market value of 7.16 per share. So here we go. We have a price as well. And since the dividend has been written in cents, so we are supposed to write the price in cents as well. So 7.16 means 716 cents. So make sure that these two values should always be either in dollars or in cents. We can't have one in dollars and the other in cents. So price is 716, dividend is 62 cents, and now we need to find out the growth. Now, how we can calculate the growth? So we have two models for calculating growth. One is the compound growth rate, and the other is the Gordon growth approximation model. For the time being, we'll be going for the compound growth rate because the information given in the question is in accordance with the compound growth rate. So what is the compound growth rate formula? Uh, it's the same as the compound interest formula, in which we calculate the sum as P S is equal to P into 1 plus R. Instead of R, I will write it growth and power N. So the sum will be the latest dividend, P will be the earliest dividend given by the examiner, G is something that we need to find out, and N will be the number of years between P and S. So looking back to the question, the earliest dividend given in the question is 55.1 cents. So we'll just write 55.1 cents as P. And according to the question, the dividend per share has grown from 55.1 to 62 cents in 2013. So definitely the growth achieved every year will be different. but we can't use those different growth rates. So we have to take a constant growth rate. So at what constant growth rate these dividends have grown? That's what we need to find out. So the latest dividend, or the dividends that we have just paid, dividend we've just paid is 62 cents. So the dividends have grown from 55.1 cents to 62 cents. We don't know at what rate. This is what we need to find out. Now, how many years uh, uh, did it take for dividend to grow from 55.1 cents to 62 cents? So we'll just exclude 2010 because this dividend was at the end of the 2010. So from 2010 to 2011, it was 1 year, then 2, and then 3 years. So we can say it took 3 years for dividend to grow from 55.1 to 62 cents. Is that clear? So we will just divide 55.1, 62 by 55.1, 62 divided by 55.1. So what is the S in the formula? S is the latest dividend. S will be the future value, right? So the earliest dividend 55.1 and the latest dividend will be the S. So 62 divided by 55.1 raised to the power 1 upon 3, because we have a power 3 on this side. So if we want to remove this power from here, we have to have a 1 upon 3 power on the other side, is equal to 1 plus Z. So I want you to solve this equation for me to find out the growth rate. Yasmin, can you just tell me this growth rate up to 2 decimal places? Approximately 4%, or is it exactly 4%, right? So from the last 3 years information, we can say that the dividends have grown by 4%, and in the absence of any other information, we will be expecting the same growth rate in the future as well. So remember, when we are putting the growth rate in the formula, we are assuming that this growth rate will continue in the foreseeable future. So let's go back to the question, and let's see how we can solve the same, how we can calculate the same growth rate using the spreadsheet. So look at the spreadsheet. All we need to do is we just need to divide the latest dividend by the earliest dividend. The latest dividend in the question is 62 cents. So we'll always write the latest dividend as the numerator value, 62. We'll divide it by the earliest dividend, which is 55.1, 55.1. Then we'll take power as 1 upon number of years, which was 3. And we'll close this by placing brackets around them. And then we'll just subtract 1 from this as per formula. So let's change the format to decimal place. And let's change it to 2 decimal place. So it's 4.01%. So if you want to see the formula, here we go. Is it clear? Is it clear? Okay, so we've calculated growth rate, we have price, we have dividend, and let's calculate cost of equity using this model. So the cost of equity, what do you want me to repeat, Shadows? Okay, growth, here we go. Simple. Latest dividend divided by the earliest dividend in the question. Latest is 62 cents, the earliest was 55.1. It's same on the Word, it's same on the Excel. So just concentrate on what I'm saying. You just need to divide the latest dividend Whether you're using a calculator or you're using the spreadsheet, you'll have to do the same. So just pick up the latest dividend, which is 62 cents, divided by the earliest dividend, 55.1. 55.1. And once you have divided this, then just take the power 1 upon 3, because the number of years between these two dividends is 3 years. So just take 1 upon 3 as the power value, and from it subtract 1. So once you are done with this, then you have to click this percentage button tab. So when you click it, this cell will show the result as a percentage. Okay, so let's now calculate cost of equity. According to the formula, we need to have current dividend, which is 62 cents, multiply it with the growth rate, which is 1 plus this, and then we have to divide this complete by the price, which is 716. And once we divide it, then we have to add growth. So just look at the formula. First, we have to multiply the current dividend, which is 62 cents, B10. We have to multiply it with 1 plus the growth rate, 1 plus the growth rate, which is in B8, 1 plus B8. Then we have to divide this whole by the price, which is 716 in B9. And we have to close all these figures by placing brackets around them. And then at the end, we have to add the growth rate again. So again, you can see that the format isn't suitable. And since cost of equity will always be in percentage form, so we need to click this percentage tab. And we need to tell the spreadsheet that we need it up to 2 decimal place. So it's 13.02%, the cost of equity. Is it clear? Great. Okay, now let's calculate the cost of equity using the CAPM model, the help of the same information given in the question, CAPM model. But before we move towards the CAPM model, let's first discuss the problems with the dividend valuation and dividend growth model. One of the problems that dividend growth model has is that it assumes that the dividends will grow at a constant rate. Now, in practice, this is not the case. Dividends may grow, may not grow, or may grow at different rates. Number one, this is the first problem that dividend growth model has. The second problem dividend growth model has is that it does not incorporate risk explicitly. But it does not mean that it isn't incorporating any level of risk. It does incorporate risk, but not explicitly. But it means that it does not incorporate project specific risk. Now, if you look at the dividends given in previous years, we are assuming that we will be giving the same dividend with the same growth rate, that is 4%. Now, don't you think that the company isn't compensating against the risk It is. If the company has been paying dividends in prior years and still has a value for its share, it means that it is able to satisfy its customers against the risk that they are taking. So the risk is there in these dividends, the impact of risk is there in these dividends, but whenever the company is undertaking a new project, there is a great chance or great probability that the new project may have a different risk from the existing risk level of the company. And what this dividend growth model fails to include is that project specific risk. So it assumes that whatever dividend and growth the company had been giving, it has been giving to its shareholders, is enough even for the new project that it is undertaking. So this is what the problem is. If the new project has a different risk level, how can we assume that the shareholders will still be ready to expect the same level of dividends? So the dividend growth model fails to incorporate project specific risk. So it won't be right thing to say that it does not include any impact of risk at all. So the right way of saying it will be that it fails to incorporate any project specific risk. So this was another problem with this. Third problem with dividend growth model is that it fails to incorporate capital gain. Now, if I'm a shareholder and I'm getting the returns, some part of the return in the shape of dividends and the other part in the shape of capital gain, so my total return will be the sum of capital gain and dividends, and not only dividends. Whereas dividend growth model assumes that the only cost that the company is paying is in the form of dividends. So it's not only the dividends, it's also the capital gain which should be incorporated, whereas the dividend growth model fails to incorporate capital gains. Another problem with the dividend growth model is that it hasn't incorporated the impact of tax. It has ignored the impact of tax as well. So these are the limitations of dividend growth model. The CAPM model, on the other hand, does incorporate project-specific risk, and we'll discuss in a while how. Secondly, it does not only consider dividends as the only return to the shareholders. It considers both dividends and capital gains as returns for the shareholders. So to this extent, it does reduce few of the problems associated with dividend growth model. So let's see how CAPM model works. CAPM models assumes that when a company has a higher level of risk, the investors will always ask for a higher level of return to get a compensation for the additional risk that they are taking. So according to the CAPM model, an investor will ask for risk premium, and this is how the CAPM model predicts the cost of equity. It says that every investor will ask for a minimum return, which is called a risk-free rate of return. For example, if you ask any investor to invest an amount into your business, even if that investor does not expect any level of risk investing in your company, even then that investor will ask for a minimum return which is called risk-free rate of return. And usually the risk-free rate of return is always taken a return against the return that investors ask from government securities or government investments, because it is assumed that the investments in government securities uh, have very low or insignificant risk. So we can assume that those government securities are risk-free investments. So any return generated by those securities will be considered as a risk-free rate of return. So every investor will at least ask for that risk-free rate of return plus the risk premium. That is the compensation for the risk that they are taking. But this risk premium will depend on the level of risk the company has. The risk that any company will show is denoted by equity beta. And the risk premium will be calculated as market return minus risk-free rate of return. Well, now what does this mean? Suppose that a particular market is giving 12% return to its investors. Remember, this is an average market return. Few companies in this market will be giving more return than this, and few companies will be giving less than this, depending upon their risk levels. The average return is 12%. And let's say the risk-free rate of return is 7%. It means that every investor will ask for a minimum of 7%. Now, what does this tell us? This tells us that this market is giving a 5% premium against the risk that this market has. But remember again, this is the average risk premium that this market is giving. It means few of the companies will be giving higher risk premium than 5%, and few will be giving less than 5% as risk premium, depending upon their respective risk levels. Now, if I place these values here, the risk-free return, which is 5%, 7%, the market return, which is 12%, minus 7%, that is the risk premium. So the average market is giving 5% risk premium. Now, definitely we won't be investing everywhere in the market. So we will be considering a particular investment. So when we'll be investing in a particular company, we'll have to look at the risk level of that particular company rather than the whole market. So if this individual company for which we are calculating this cost of equity is as risky as the average market, it will mean that it has an equity beta of 1 time. So we'll just multiply it with 1. So it will give us the same risk premium as the average market risk premium. So it means we'll be asking the same risk premium from this company as generated by the market at large. But in case this specific company which we are talking about has more risk than the average market, then definitely we'll be asking a higher return or higher risk premium from this company. Let's say the company that we are talking about has 1.5 times equity beta, meaning that it is 1.5 times as risky as the average market. Or you can say that the share price of this company is 1.5 times volatile compared with the average market. Or in other words, we can say that when the average market prices go up by 10%, this company's price goes up by 15%, that is 1.5 times. And whenever the average market prices go down by 10%, this company's share price is expected to go down by 15%, 1.5 times. So this equity beta is actually the measure of risk, compared with the average market. So I hope it's clear. So if this company has equity beta of 1.5 times, it means we'll be asking 1.5 times of the risk premium from this company. So 7% plus, if from the average market, the investors are expecting 5% risk premium, we will be expecting a higher risk premium because of a higher risk associated with this investment, which is 1.5 times. So we'll just take 1.5 times of the risk premium, which is 5%. So can I have 1.5 times of 5%? 7.5. So this is the risk premium that we expect from this company. And 5% is the risk premium that we expect on average from the market. So 7.5 plus 7% will give us, sorry, 14.5. So the expected return from this company predicted by the cost of equity CAPM model will be 14.5%. Now, through this equity beta, we are adjusting the project specific risk. That's why we say the CAPM model always gives us the risk, the project specific cost of equity or discount rate, because it incorporates the risk level of the investment, specific risk level of the investment. Is that clear? Any questions? Any questions? It's equity beta. It's not B, it's the sign of beta. It's equity beta. So let's move towards the question, and I want you people to solve this question for me using the information given in this question. Calculate the cost of equity. Okay, now all of you who have come up with the answers have used 1.038 as equity beta, right? 1.6. Do we have any equity beta equal to 1.6? Yep, we have 1.6. Here we go. So if you have used equity beta equal to 1.038, or you have used 1.6, in either ways, these should not have been used. The reason why: if you look at this question, it says the current risk-free rate of return is 4% and the average equity risk premium is 4%. Card company pays profit tax at the rate of 30% per year and has an equity beta of 1.6. See, this equity beta shows the risk level that the card company currently has. Whereas if you look at this information given in this para, card company is planning to invest a significant amount of money into a joint venture in a new business area. So it's moving towards a new business area, which would mean that the new business area may have a different risk level than the current risk level of card company. So if we still continue to use 1.6 as the equity beta, which it will mean that we have used the same risk level of the company, whereas the new business may have a different risk level. So we have to make sure that we are using the right equity beta, and this should be for a business which the company is going to undertake rather than which the company is currently undertaking, because the cost of equity will be calculated for the purpose of appraising the new project. Now, if we continue reading this paragraph further, it has identified a proxy company. Now, proxy company means a company that you can say is a similar company, similar to the you can say it's a similar size company, and you can compare it with your company. So not only same industry, as Fernandez, not only same industry, it should be in the same industry, and it should be same in the size, or the level of operations of its company will be similar to your operations. You can call it as a proxy company for you. So it has identified a proxy company with a similar business risk to the joint venture. So whatever business you are doing, this company has the same business risk. The proxy company has an equity beta of 1.038, and it is financed by 75% equity and 25% debts. Now, its capital structure says that it has 75% equity and 25% debts. Now, my question to all of you is, if card company has a higher proportion of debts, what do you think? Will the risk level of card company will be higher than this company or lower than this company in case it has higher debts? Everyone. If card company has higher debt to equity ratio than this proxy company, what will be its risk level? A higher risk level than this proxy company or a lower risk level than this company? So it's very simple. Debts mean you have to pay your liability in future. And if you have a liability to be paid in the future, it means you may have a risk of not paying that liability. So any company which has higher debt to equity ratio will definitely have a higher risk. And that higher risk is called financial risk. So if any company which has a higher debt to equity ratio will always have a higher financial risk. So in case card company has a higher debt to equity ratio, then it will also have a higher financial risk. So Snedden, whenever a company has more debts, it means it has to pay its liability in the future, and more liability means a higher risk that it may not pay those debts. So whenever a company, yep, to be cheaper and to be riskier, these are two different things. The cost of the debt is lower, but after all, it's a debt and you have to pay whatever happens in the future. So what will happen if you don't have the ability to pay the debts? You still will be required to pay the debts, and that may force you into liquidation. If you fail to pay your debts on time, it might force you to go into liquidation. So debts are cheaper, but at the same time, they are more riskier because you have to pay them at the end of the day. So more debts, more financial risk. Now remember, equity beta of any company, equity beta of any company shows two types of risks. One is the financial risk, and the other is called business risk. So equity beta of any company will be showing both types of risks. So if we are going into a particular business and we have a proxy company which is doing the same business at the same level, both of us will have the same business risk. Both will have the same business risk because we'll be doing the same business as the proxy company. So the business risk for both companies will be same, but not necessarily that the financial risk will be same. We will be doing the same business, therefore we'll be having the same business risk. But since we may have different capital structure, we may have different debt to equity ratio, therefore we will be having different financial risk. So if a proxy company's equity beta is given in a question, we can't use it straight away as our equity beta, because this equity beta of the proxy company will show the business risk and financial risk of that company. So we share the business risk, but we don't share the financial risk if our debt to equity ratio is different from that company. So in that case, we can't use its equity beta as our equity beta. So what will we be doing in that case? We need to adjust this equity beta, and I will just explain this thing later, how to change this equity beta. But for the time being, you just need to keep this in your mind, that equity beta shows both business risk and financial risk. Now, I've explained the financial risk, that financial risk is the risk that the company may not pay its liabilities when they fall due. This is the risk. This is the financial risk. On the other hand, a business risk is the risk that the business may not cover its operating costs. It may not have enough sales to recover its variable and fixed costs, and usually it's fixed cost which may put you in danger. So the risk of not covering the operating cost is called business risk, and the risk of not paying your liabilities on time is called financial risk. So a business which has debts in its capital structure will be facing both types of risks. But a business which does not have any debts in its capital structure and is 100% equity finance will only face one risk, and that is business risk. So remember that equity beta reflects both types of risks. So if we go back to this question again, this proxy company has 25% debts. Now, if we also have 25% debts, we can use this equity beta straight away as our equity beta, because we are going to do the same business as this company, so we'll have the same business risk. And since the equity beta, the debt to equity ratio is assumed to be the same, so we can use this equity beta as our equity beta. And for the time being, I'm assuming that both of us both of us have the same debt to equity ratio, which is 25% and 75%. So we can straight away use this equity beta, but for sure we can't use this equity beta because this equity beta shows the current risk level of the card company, whereas we are entering into a new market, so we'll have a new business risk reflected by this equity beta. So let's calculate the cost of equity, assuming that we also have the same percentage of debts in our capital structure. So we'll use the same equity beta as our equity beta. So the CAPM model, in a CAPM model, we'll have to take risk-free rate of return, which is 4%, 0.04, plus equity beta, 1.038, multiplied with the risk premium, and the market risk premium, equity risk premium is 5%. So 0.04 plus 1.038 into 0.05. So let's convert it into a percentage. It's 9.91%. But remember, I have assumed that we have the same capital structure as the proxy company. This is just a mere assumption. That's why we are taking the same equity beta as our equity beta. Because if we have the same debt to equity ratio and we are entering into the same business, it means we will have the same business risk as well as the same financial risk. So we can use that equity beta. Is that clear? So it's 9.19%. Let's go to the next question. Okay, let me give you a question and solve that question for me. Thank you, Azra. Yeah, it won't happen. I have an eye on that. That's why I'm not starting a new question. So I'll be restarting it, but I have to take a prayers break for 5 minutes. Okay, let's calculate it. Cost of equity, risk-free rate of return, which is 6%, equity beta, which is 8%, market return is 14%, the risk-free rate of return is 6. So the difference between the two is called risk premium. Risk premium. So 8 into 1.8 plus 6. Is it 20.4? So the cost of equity will be 20.4. Okay, let us take a 5 minutes break, or I think it's better to take a 10 minutes break. So let's take a 10 minutes break, and once we'll be back, we'll discuss how to uh, calculate asset beta with the help of equity beta, and we'll discuss what asset beta is. So let's take a 10 minutes break and we'll be back. Hello everyone, we are back and I hope you people can hear me. Okay, so we were discussing the equity beta. So as I said that equity beta of any company reflects both financial and business risk. And we may share a business risk with a particular company, but not the financial risk. So what to do in that case? In that case, we have a formula, which is equity beta is equal to, sorry, it's asset beta is equal to equity beta into equity of the company divided by equity plus debt of the company 1 minus tax. Here we have a formula. Remember, as I told you, that equity beta shows both business and financial risk of the company. On the other hand, asset beta of any company shows business risk only. So this formula is very helpful formula for incorporating or eliminating financial risk from beta values. For example, if we have been given equity beta of a proxy company, let's say it's 1.6 for, let's say, company A. It's company A, and we are company B, and we are entering into the same business as the business of company A. So it means that we will have the same business risk, but we have a different debt to equity ratio. The debt to equity ratio is 30-70, which means 30% debts and 70% equity. Whereas this company has, let's say, 50-50 debt to equity ratio. Now, if you can see, we have only 30% debts and this company has 50% debts. So it has a higher risk of not paying its debts than us if you only have 30% debts. So we do have a risk that we may fail to pay our debts, but as compared to company A, we have a lower risk because we only have to pay 30% debts and they have to pay 50% debts out of its total investments. So it means that this 1.6 equity beta shows the higher financial risk of this company as well as the business risk. As far as the business risk is concerned, we have the same business risk as of company A because we are entering into the same market as company A with the same activity level and all that stuff. So we have the same business risk, but we cannot use the equity beta of this company as it not only shows the businesses but also the higher financial risk. So what to do now? Now what we'll do is we'll just put this equity beta into this equation and we'll use the debt to equity ratio of this company here and try to find out the asset beta of this company, which will only be showing the business risk. And definitely that asset beta will be lower than 1.6 because it will only be showing the business risk of the company. So the first step will be to find out the asset beta of this company. This process is called ungearing the beta because we are eliminating the financial risk. It means we are ungearing the company and we're just taking the business risk of the company. So this process is called ungearing. So let's calculate with the help of this information the asset beta of this company. So equity beta is 1.6 multiplied by the equity, which is 50, divided by 50 equity plus 50 debts. And let's say we have a tax rate of 30%. I'm assuming this tax rate. So we have a tax rate of 30%, 1 minus 0.3. So can I have the answer quickly? What will be the asset beta? That is the beta that reflects the business risk only. 0.94, and you can see it's lower than the equity beta, and for a very obvious reason, that we have offloaded the financial risk. So 1.6 includes the financial risk, and 0.94 includes only business risk. So since we have the same business risk, we'll have the same asset beta. But we can't use this as our equity beta because we are also a geared company. We also have debts in our capital structure, and we also have a financial risk. Though it's different from the company A's financial risk, but we still have a financial risk. So we must re-gear this asset beta. So we'll use the same formula again, but this time we have asset beta. So in place of asset beta, we'll write 0.94. And now we are calculating our equity beta, which will be showing our financial risk. So we must use the debt to equity ratio of our company, this one now. So it will be 70 divided by 70 plus 30 into 1 minus 0.3. So what we are doing is we are re-gearing this equity, re-gearing this beta to incorporate our financial risk into this beta value. So can I have the answer of this equity beta? Now this will be more than 0.94 because we are incorporating the financial risk, but less than 1.6 because we have a lower financial risk than company B. So our equity beta will be less than 1.6 and more than 0.94. So all you have to do is this will give us 30 into 0.7, 21, 21 plus 70, 91. Just multiply 91 with 0.94 and divide it by 70 and 1.22. So this is our equity beta. Now, when we will be calculating our cost of equity, this is the equity beta that we should be using in that formula. And remember, this equity beta should never be in percentage. It should be as it is, 1.22, 1.3, 1.4, whatever the value will be. It should be in times, not percentage. So this is equity beta, and now this equity beta shows the same business risk, but a different financial risk. Is it clear? Come on, is it clear? Sneha, what do you want me to repeat? As the asset beta, this asset beta is showing business risk only. Okay, so whereas our company is a geared company, so we will not only have the business risk, but we will also have the financial risk. So, but this asset beta is only showing business risk. So we have to calculate equity beta again, but this time we have to incorporate our financial risk. So the way through which we can calculate, incorporate our financial risk will be using our own debt to equity ratio, which is 30/70. So we'll just put 0.94 in place of asset beta, and we will calculate our equity beta using our debt to equity ratio. In that case, we will be able to incorporate our financial risk into our beta value. So from 0.94, it is now 1.22, reflecting that the financial risk is also incorporated. 1.22. Now, whenever we'll be using the CAPM model, this will be the equity beta that we'll be using for calculating our cost of equity. Which formula? It's the same formula. This same formula will be used for both asset beta and equity beta. No, I don't think this formula will be given in the exams. You have to memorize this formula for, you'll have to memorize this formula. Are you sure, GS? You have to go through the formula sheet is given in the past exam questions. You can see there what exam formulas will be given. But I'm not sure whether this formula will be given in the exams. Even if it's not given, it's very simple formula. It's just a concept-based formula. Okay, so the time up. We'll restart it again. Okay, let's calculate the market value weighted average cost of capital. Now, first of all, let's calculate the cost of equity. And if you look at this question, uh, AMH company wishes to calculate its current cost of capital for use as a discount rate in investment appraisal. The following financial information relates to AMH company. Ordinary shares, it's 4 million with the par value of 50 cents per share. Reserves 18 million, the total equity 22 million. Long-term liabilities, it includes 4% preference shares with a nominal value of $1 with a total par value of 3 million. 7% bonds redeemable after 6 years with 3 million value. Bank loan 1 million. And in total liabilities are 7 million, and the total debt plus liabilities will be 29 million. The ordinary shares of the AMH company has an ex-div market value of $4.7 per share, and an ordinary dividend of 36.3 cents per share has just been paid. Historic dividend payments have been made as follows: in 2008, which is the earliest year, it's 30.9 cents, and the latest year, which is 2011, it's not the latest year, it's 2011, which is the dividend paid was 35 cents, and the recent dividend which is paid is 36.3. So this is the latest dividend that has been paid. The preference shares of the company, so forget about the preference shares. Let's first calculate the cost of equity. And what do you think, which model should be used for calculating the cost of equity? Dividend valuation model or dividend growth model? Yeah, because we don't have any other information available to use the CAPM model, and this will always be the case in the exam questions. Yes, most of the times you will have to identify the model yourself from the information given. So cost of equity, let's calculate. What information do we need? We need dividend, current dividend, which is 36.3 cents. 36.3 cents. We need price, which is should be XDiv, which is 4.7, which 4.7 means 470 cents. Okay, we've got D, we've got price. Now we need to calculate the growth. So here again, we have to calculate the compound growth rate with the latest dividend in the numerator, the latest dividend 36.3 divided by the earliest dividend, which is 30.9, raised to the power 1 divided by number of years in between these two values. Ignore 2008. So we'll start counting from 2009, 1, 2, 3, and that's this one, 4. So it has been 4 years because we are at the end of 2012. So 1, 2, 3, and 2012, 4. So it's 4 years. So 36.3 divided by 30.9 raised to the power 1 divided by 4, and let's put brackets around them, minus 1, enter, and let's change the format into percentage, 2 decimal place, it's 4.11%. So here we go, we've got all the variables that should be used in the dividend valuation model. So let's calculate the cost of equity. Cost of equity will be equal to dividends into 1 plus growth divided by the price, and then we will add the growth at the end and change the format to 2 decimal places. It's 12.15% approximately. So this is the cost of equity. So before we can calculate the cost of capital, we must first calculate the cost of equity and cost of debts. So we're done with the cost of equity part. Now let's calculate the cost of debts. So for the cost of debts, we need to identify what types of debts do we have. One type of the debts that we have is preference shares. So let's first calculate the cost of preference shares. The cost of preference shares, it's since nothing is mentioned regarding whether they are redeemable. Yeah, here we go. We have an information. The preference shares of AMH company are not redeemable. It makes a lot of difference. So for the time being, let's discuss what we will have to do with irredeemable debts. So these are not redeemable and have an active market value of 40 cents per share. Very important information. So after that, we have information regarding bonds. For the time being, we'll just ignore the bonds. Let's calculate the cost of debt of preference shares. So if the preference shares are irredeemable, it means we have to pay dividends in perpetuity. So the dividends that will be paid in perpetuity should be divided by the price against which those dividends are being paid. So it will tell you what rate of return you are giving to your investors. The same rate of return will be your cost of debt. So dividends will be paid as 4%. And remember, this 4% should always be applied to the par value. So the par value is $1. 4% of $1 will give you 4 cents. So it will be 4 cents per share. So it means that we will be paying 4 cents against every share. Now, the value of this share in the market is 40 cents. That means the investors are getting 4 cents against their 40 cents investment. So the rate of return from the investor's point of view will be 4 divided by 40, and the same will be the cost of debt for us. It's 10%. So the investors will say that they're getting 10% return against investment. And we will say as a company that we are paying 10% to our investors, which is, since we are the payers, for us, it will be the cost. And for the investors, it will be the rate of return. Is that clear? Okay, so we've calculated the cost. So for every irredeemable debt, all we have to do is to find out what we are paying divided by the price against what we are paying. So this is the cost of debt of preference shares. Now let's move towards the redeemable bonds, and this is something tricky. The 7% bonds are redeemable at a 5% premium to their nominal value of $100 and have an X interest market value of 104.5. The bank loan, or forget about the bank loan. So let's first discuss these bonds. These bonds are redeemable, and at the moment they have a market value of 104.5. It means that the investors will have to invest $104.5 today. This will be their initial investment, and against this investment they will be getting 7% interest every year in annuity for 6 years. And after the end of the 6th year, they will also get the redemption value, which is 5% above the par value. So against their investment of 104.5, they will be getting two types of cash inflows. One in the form of interest, which will be received every year, that is annuity. And the other will be, you can say, the scrap value, as in case of machines bought. So you can say that they will get, against what they have invested, the redemption value, which is 5% more than the $100. So now, how to calculate the cost of debt? Now, if we look at from the investor's perspective, what is the difference between redeemable and irredeemable? Hamad, the redeemable debts mean that you will invest something, and after a certain period of time, you will get your amount back. It means it's redeemable. For example, if you have bought redeemable bonds of the company for 5 years, after 5 years, you will get back your invested amount. Irredeemable means that your investment will be there in the company for foreseeable future, and you won't get it back after a definite period of time. You won't get that back. So that's called irredeemable. So how will we be calculating the IRR? Sorry, how will we be calculating the cost of debt of redeemable bonds? Now look at it from investor's perspective. The investor is getting something in annuity for 6 years, a fixed amount every year for 6 years, and he's also going to get an amount equal to $105 at the end of 6th year. This is the two things that he's going to get against his investment of 104.5 today. So if we are able to calculate the rate of return for the investor, the same rate of return will be the cost of debt for the company. So it means that we have to calculate the IRR of this investment in the same way as we were calculating IRR in our investment appraisal topic. So we have to calculate the IRR of this bond, which will be the cost of debt for the company. So how we calculate it, let's see. Cost of debt of loan notes. Cost of debt of loan notes. We'll have to follow the same approach. We'll have to follow the same approach as we did in calculating IRR. So what we need to do is year cash flows. First, let's identify the cash flows that the investor is going to receive. First, the investor will be receiving from year 1 to year 5. From year 1 to year 6, it will be receiving the interest, which is 7%, 7% of the par value, and usually the par value will be $100, and it's mentioned here. So 7% of $100 will give us $7. But the $7 is an expense for the company, and since it's interest, so therefore it means that the company can claim it as an expense and can reduce its tax liability. So whenever it is the interest based debts, we have to deduct the tax from it. So we'll always have to show it after tax. So 1 minus tax rate, which is 30%. So remember to show the amount of interest after tax. So it will be after tax 4.9. So the company is going to receive, oh, sorry, the investor is going to receive $4.9 every year against its investment in the form of interest. Now, this will be received in annuity for 6 years. So just if you can just quickly tell me the annuity factor for, let's say, if we assume 5% as our discount rate, because you know that for IRR we have to assume two different discount rates, one rate for positive NPV and one rate for negative NPV. So let's assume that the first rate will be 5%. So if you can just go back to your discount factor and annuity factor table and tell me what will be the annuity factor at 5% for 6 years. I hope you people have the NVT table with you. Just tell me the NVT factor for at 5% for 6 years. 5.0. Is it 7.6 or 6.7? 5.076. Okay. 7.6. Okay. So let's calculate the present value. Present value at 5%. Okay. Then at the end of the 6 year, uh, the the investor is going to receive 5% additional to its par value, which means he will receive $1,045, but it will be a lump sum, a single value. So to calculate the present value, we will be using the discount factor rather than the annuity factor. So if you can just tell me the discount factor at 5% for the 6th year. 0.746. Okay, let's calculate the present value. Here we go. We've got the present value, and this will be the total cash inflows, 103, and from it we'll be deducting the current market value, that is the initial investment for the investor, 104.5, in order to calculate the NPV. So the NPV here is already negative. It's already negative, so we have to reduce the discount factor further to get the positive NPV, because we already got the negative NPV. So let's take 3%. So can I have the discount factor for 3%? Annuity factor for 3%. 5.417. Okay, let's calculate the present value, multiply it with the cash flows. Now we are getting present values at 3% in the same way as we were doing in investment appraisal. Okay, can I have the discount factor at the same rate? Okay, 0.837. So here we go, we've got the present value. So I'll just copy this formula here. So we'll get the sum of these two. And since the investment will remain the same, so I'll just write it here. And this time I've got a positive NPV. So we've got two NPVs here. Let's calculate the IRR. And you know, in IRR, we have to write the lower rate, which is 3%, 0.03, plus the positive NPV, 9.93, divided by the positive NPV minus the negative NPV. And let's close the brackets. And then multiply it with the difference between the two rates, which is 2%, 0.02. The difference between 5 and 3. And Okay, probably we have made a mistake. Positive minus. Yeah, it should be 4.76, around 4.76%, but I'm not sure what mistake did I make. It should be 3.03 plus positive in PV divided by positive minus negative, bracket close, into 0.02. 5 minus 3. Yeah, there we go. It's 4.77% the IRR. So this is IRR and IRR for the investor and cost of debt for the company. So we can call it as our cost of debt of the loan notes. So it means that the investors are being paid at the rate of 4.77. Hassan, it's not advisable to do so, because if you are being asked to solve the questions on spreadsheet, it means you have to use the features of the spreadsheet. That's the reason why spreadsheet has been given, so that you can build your skills of using this spreadsheet. So you should not use your calculators while you're using the spreadsheet. You should be using the spreadsheet. So so we've got the cost of debt of uh, the loan notes. Now let's calculate the cost of debt of the bank loan. And it's easy to calculate the cost of debt of the bank loan, because the bank loan will have no market value. Uh, it is supposed to be redeemed. So at the same value at what it has been invested. So it's very simple to calculate the cost of debt of bank loan. Just pick up the interest rate, which is here we go. It says it has a 4% interest rate. So we'll just pick the 4%. 4%, 0.04. And we'll just make it after tax. That's it. Simple. 0.7. We'll just take 70% of it. And this will be the cost of 2.8%. So remember, it's very easy to calculate the cost of debt of bank loan. It will just be the interest rate minus the tax. That's it. So we've got three types of cost of debts, as we had three types of debts. Here we go. Okay, and we have also calculated the cost of equity, which is 12.14%. Now we have to calculate the weighted average cost of capital. And according to the question, it says we must use market values for calculating the weighted average cost of capital. What does this mean? It means that we have to calculate market values first. First, we have to calculate the market value of equity. And how many number of shares do we have in issue for equity? It's $4 million, the par value, with each share being each share having a value of 50 cents par value. So to calculate the total number of shares, we need to divide this 4 million by $0.5 in order to find the total number of shares. So remember, if you are supposed to calculate the total number of shares, divide the total par value with the par value per share. So we'll get the total number of shares, and each share has a market value of $4.7. So 4 million divided by 0.5 to get the total number of shares, multiply by 4.7 to get the total market value. And these values are in thousands, so let's write it like this. So 37,600, it's equity. Then let's take the market value of preference shares. The total number of shares will be 3 million, so we don't need to divide it by 1. It's 1, it's understood. 3,000 multiplied with the share per price per share, which is 40 cents. So 3,000 into 0.4, we have to write it in dollars. And then we have bonds. The bonds have a par value of 3,000 or 3 million divided by the par value, which is 100, to get the total number of loan notes, multiplied with the market value, which is 104.5. So, and the bank loan will always have the same market value because bank loan cannot be traded. Therefore, it will have no market value. It should be reported at its par value. So this is the capital structure of the company. Now we have to use these values to calculate the average cost of capital. So let's sum them together to find out the total value of capital. This is total capital, 42935, of which 37,600 is equity. So what we can do is we just calculate the percentages divided by total. So market value for what? For shares. Here we go. Par value divided by the price per share, the par value per share, to find out the total number of shares, and then multiply it with the market price per share to get the total market value. Then preference shares, 3 million, as the par value was 1. So whether we divide it by 1 or we don't divide it by 1, the answer will remain the same. So it will be 3,000 into price per share, market price per share, to get the total market value of the preference shares. Then we have bonds, the par value of the bond, the total par value of the bond, which is 3 million, divided by the par value per bond to find out the total number of bonds, and then multiply it with the current market price per bond to get the total market value of the bonds. With the bank loan, we don't need to do anything because bank loan cannot be traded in the market. So if we sum all these together, it will give us the total market value of our capital. Now, if we want to calculate the percentage that how much of the total capital is from equity source, so we have to divide 37,600 by 42935. Here we go. And let's just change the format to percentage. It gives us 87.57%. Now I want to copy it down, but the problem is that if I copy it down, it will change the reference from B26 to B27, which I want it to change, but it will also change the reference of B30 to B31, and it means it will take this nil value, which I don't want to change. Therefore, I will just place $sign before B and before 30. So I don't need to place it before both, but to make it simple for you, just place it before both. So if I place $signs before both these B and 30, it will make it an absolute reference. And when I copy the formula in the lower cell, it will not change this B30, and it will take 42935 as a denominator value for all these cells. So here we go. And if I take the sum of all, it will give me 100%. So we can say that 80% of our total capital is sourced through equity, 2.79% from preference shares, bonds 7.3%. Now we'll just place the the cost figures we calculated in front of every source of capital. Preference shares, then it's the bonds, and then it's the bank loan. And let's put it as this. We've got the percentages, and we just need to multiply these values together, and then we'll just sum all the values, and we'll change the format to percentage. So the final answer, 11.33, is our weighted average cost of capital, VACC. This is called the weightage. And this is your weighted average cost of capital. So it means the weighted average cost of capital of this company will be 11.33%. It's in between 2.8%, the cheapest source, and 12.1%, the expensive source. Is it clear? What type of commit are you talking about, Snedden? No, in WACC, in the cost of capital, we don't have to give such comments. It will just be used as a cost of capital for evaluating projects. Yeah, we can have different types of discussions, which we're not going to discuss at the moment, but we can have different types of discussions that why we should be using WACC instead of using cost of equity, or why a company may have a lower WACC using the market value, why a company may have a higher WACC using market values than using the book values. So these types of discussions may be there, but we are not discussing that at the moment. So any resource from where to do practice of using spreadsheets like under exam conditions? Well, I will uh, just give me a couple of days. I will give you people access to my website where you can practice F9 questions in the same way as you will be attempting in the exams. Just give me a couple of days. We're just making a few adjustments to that, and we'll give you the access. But stay on the WhatsApp group. I will update you all on that WhatsApp group about the status of getting access to that website. Well, SF Snedden, unfortunately, we only had 10 hours at our disposal, and I'm trying to make best use of those 10 hours. So whatever is possible within these 10 hours, I will try to uh, give you a maximum that I can. But do consider the limitation of these 10 hours because it was a practice to pass session. So I hope you've got the VAC. So we've calculated the VAC and I hope you all have understood it. So let's move forward. So the next question is estimate the value of car company using the price earning ratio method and discuss the usefulness of the variables that you've used. In this question, we have to calculate the value of the company rather than the cost of capital or cost of equity. So we have to calculate the value of the company using the price earning ratio method. Before I can actually go and solve this question, let's first discuss uh, why do we need to value a company and what is actually valuation of a company. It's very simple. If you want to buy a company, or in other words, let's make it more simple. If you want to buy a cell phone, you need to have a value in your mind before you can actually buy that cell phone. It's not like that whatever the shopkeeper will tell you the price and you will go and buy it. No, you have to have a value in your mind, looking at the features of the cell phone, looking at your own need, and then you will have a value in that mind, and you will only accept buying the cell phone if that value matches with the value quoted by the shopkeeper. So in the same case, when you're buying a company uh, or you're acquiring a company, you must first value the company, and you must find out what maximum and minimum you should be willing to pay for that company before you can actually quote any value for that company. So this is called business valuation, and this is done for several reasons. You may be acquiring a company. For that you need to value a company. You may be selling your own company to someone. Maybe that's the reason you are valuing a company. Maybe you are going into a stock market. You may be trying to float your shares into the stock market, and for that you need a price. So you may be calculating the value of the company for that reason. So you may have different reasons for calculating the value of the company. So uh, how we calculate the value of the company? One of the models that we can use to calculate the value of the company will be price earning ratio, which is price divided by earnings, that is MPPS divided by EPS, the earning per share. It can be on a per share basis or it can be on a total basis. So MPPS, this is the market price per share divided by the earning price per share. This is price earning ratio. If we rearrange this PE ratio for calculating the price, it will be like MPPS will be equal to PE ratio into earning per share. So if you multiply the price earning ratio with the earning per share, you will get the market price per share. So let's say the price earning ratio is 10 times and the earning per share of a company is $2 per share. It means that if the price earning ratio is 10 times, it means that the price is 10 times of the earnings. It means that the investor is ready or willing to pay 10 times of the earnings as the price. So if the earning of a company is 2, its 10 times will be equal to 20. So it means that the share will have a market price of $20 as per the PE ratio. And in this way, we can calculate the price of the company. But the problem is from where to get this PE ratio. The PE ratio is calculated by using the market price per share of divided by earning price per share. And market price per share is what we are going to find. So as you all know, we can't have two variables. We can't find two variables from one equation. So if we don't have PE ratio, we don't have market price per share, what to do? So what we'll have to do is we have to pick PE ratio of any other company rather than our own company. And that company should be the proxy company. And it should be a similar size company than the company for which we are calculating the P of a price per share. So we'll pick the PE ratio of a similar company and multiply it with the earning per share to get the price per share. This is the price earning ratio model. Let's move towards the question and it will be further clear. Estimate the value of the Corhick company using the PE ratio method and discuss the usefulness. So let's calculate the value of the company. Look at this question. The forecast financial information relating to the company is as follows. The earning of the company in the future will be 3,000 for the first year, 3,600 for the second year, and $4,300 for the third year. Since we have variations in the earning, the best way will be to calculate average earnings. So the average earnings of this company expected in the future will be 3,000 plus 3,600 plus 4,300 divided by 3. So the average earnings are 3,633 and the figures will be in thousands. So now what we need is a PE ratio of a similar size company. Let's find out in the question whether we have a PE ratio for this company. During the course of the last 2 years, the company acted to reduce its gearing and etc. etc. Let's find out whether we have a PE ratio. Yeah, here we go. The current average PE ratio of listed companies similar to Corhig is 5 times. So a similar companies, the average PE ratio of similar companies is 5 times. So the total value of the company will be 5 times of the earnings. That is 3,633 into 5. And here we go. This is the total earnings. And it will be 181,667. And again, it will be in thousands. So this will be the total value of the company. So it's a very simple model to use. Just you need to pick up the earnings, but remember the earnings should be on for a particular year. In case we don't have earnings, we have earnings for several years in the future. So we'll take the average as we did it in this case. But usually in the exam question, you will be given the earning per share or the earnings of the company for a particular year. And it should be the latest year. So we'll assume that in the future, the earnings will continue to be at the same level and we'll multiply it with the EPS to get the total value of the company. Is it clear? Any questions? Is it clear? Is it tricky? I think it's very simple. Pick the average earnings as far as possible. In case you don't have average earnings, you've been given earning for a particular year, just use that earning, assume that this earning will continue in the future, and just take those earnings, multiply it with the PE ratio to get the total value of the company. Yeah, I know this topic by and large is a very tricky topic, and what we can do is, because it's a practice to pass session, so what we can do is we can have a separate session for business valuation once this session is over. Tomorrow will be the last day of the practice to pass, and let's uh, I'll try to arrange a separate session for all of you for business valuation, and I'll discuss business valuation from very basics. So, but since it's a practice to pass session, so here we'll be focusing on more on practice than focusing on the basic calculations. So this was the value of the company using the price earning ratio. Now, it says calculate the current cost of equity of Correct company using this value. Calculate the value of the company using dividend valuation model. So now we have to use dividend valuation model. So we'll just go back and see what dividend valuation model formula was. The dividend valuation model formula was KE is equal to D into 1 plus G divided by price plus Z. Now, if we want to find out the price with the help of this formula, we have to rearrange this formula. Now, how we can rearrange this formula? First, we have to take this plus Z to the other side, and it will be KE minus G, KE minus Z, and D into 1 plus G divided by P. So if we want to take P to the other side, we'll have to take the whole, this whole down here. So the formula will now be P is equal to D into 1 plus G divided by KE minus G. So we've just arranged this formula of dividend growth model for price now. So again, we need the same variables. We need dividend, we need the growth, we need cost of equity this time instead of the price, because price is something that we need to find out. So let's search for those variables. First of all, we need to find out the cost of equity. So if you look at this question, we have information for the cost of equity. Correct company has a current before tax and equity beta of 1.6. So it has an equity beta of 1.6. The risk-free rate of return is 4%. The equity risk premium is 5%. So we can easily calculate the cost of equity with the help of this information. The risk-free rate of return is 4% plus equity beta is 1.6 into risk premium, which is 5%, 0.05. So the cost of equity is 12%. So one of the variables is now known to us. The other variable will be to find out the dividend. So what's the latest dividend paid? So since we only have 5 minutes left, and according to this question, we don't have constant dividends. It's nil for the first year, then it's different amount of dividend in second year, then we have a different amount of dividend in the third year, then we have dividends after year 3, and which will be growing at 3% per year. So I'm not going into this detail now. I'll keep it simple for the time being, and when we'll be back tomorrow, I'll continue with the same question with the same dividends. For the time being, I'm assuming that the dividends will be constant, and let's say the dividends will be say 30 cents per share, and this will grow at 3% per year. This will grow at 3% per year. I'm just keeping things simple so that you can understand how we can use this formula for calculating the price. So I'm assuming that the dividends will be 30 cents, which will grow at 3% per year. So let's calculate the price. It will be dividend, which is 30 cents into 1 plus growth, 3%, the whole divided by KE, which is 12%, minus the growth, which is 3%. And $34.33 is the price per share, and if we want to quote it in dollars, we have to divide it by 100. So it will be now in dollars, $3.43 per share. So this is a very simple way of calculating the price, because I've assumed that the dividends will be constant and it will be growing at a constant rate. So in that case, this will be the price per share. But according to the question, we are not paying any dividend the first year. We're paying a different amount of dividend in the second year. We're paying a different amount in the third year, and then later on it will continue in perpetuity. So tomorrow when we'll start, I'll start with the same question, and we will solve it according to the information given in the question rather than assuming anything else. So if a question is as simple as I have made it in this case, this is the way we will be solving it. So here is the formula. So we'll start the same question again tomorrow. And I will request all of you, I'll request all of you to go through my business valuation and cost of capital lectures on Vimeo. Uh, Go to Vimeo. The link is there in the chat box. There you'll find my lectures for business valuation and cost of capital in detail. So if you go through those lectures and come back for the practice, it will be really helpful. We won't be covering all the topics tomorrow. Definitely, it will be just 2.5 hours. But I'll make sure that I deliver 1 or 2 extra sessions for key topics. Yasmin, if you look at the chat box, there is a link for Vimeo, vimeo.com/ACCA Pakistan. Just go there and search for F9 lectures. You will find F9 lectures for December session, for September session of 2017, and you will find all of my lectures there for day 1, day 2, day 3, day 4, day 5. I'm not sure on which day I taught business valuation or cost of capital, but you just can go through those lectures. You'll find the lectures for business valuation and cost of capital. Okay, just send me, in case you people are not on the WhatsApp group, just send me the message on the WhatsApp. Here's my WhatsApp number. I'm just writing the WhatsApp number. In case you are sending me outside the Pakistan or within the Pakistan, it's 0321 2604033. So it's within the Pakistan. It's if somebody is texting me from outside Pakistan, this should be the number. So just text me on the WhatsApp, and I'll just send you the link to the WhatsApp group, and we'll be in touch on that WhatsApp group. I hope the session was helpful to some extent today. We'll be continuing with the same 2 topics, business valuation and cost of capital, tomorrow as well. Okay, have a good day and best of luck.